Hey everyone, Matt Quinlan from Classified Realty Group here with Brian Mahoney from Guaranteed Rate.
Hello.
One of my trusted lenders. And we just want to take a little time to chat with you about the real estate market right now and affordability. Right now, market has certainly slowed down. Homes are sitting a little bit longer on the market.
On average, right?
On average, yeah. They're spending, realistically over the last couple of years, we were seeing days to offer was like 7.
Right, so an realistically unrealistic market, right?
Yeah. Exactly. And so I think now we're seeing some of the main road houses, we're seeing some of the fixer-uppers, or even just the homes that need a little bit of elbow grease, sitting a little bit longer.
What about something that's mispriced?
The market is up, and so buyers are not going to pay more than it's worth. I think the trend over the last few years has always been, if they feel like it's a good deal, then they're going to pay whatever they feel they need to pay and whatever they can afford. If they feel like the home is overpriced, then maybe they're thinking the seller's not being realistic, and then they forget about it.
Have you found lately that maybe sellers are being less realistic than they were a year or two ago because they heard a neighbor last year sold and got offers X amount of dollars over asking?
Yeah, and I think for the last few years, again, we have said, oh, my neighbor's house sold for $550 3 years ago, I should list mine at $580. Where realistically, your neighbor's house sold for $550, you should list it at $550.
Yeah.
We're kind of, as we mentioned earlier, it's more of a balanced market.
A little bit more balanced, right? I can remember back the last couple of years, I have clients who I literally wrote 10, 12 letters for to try to find different. So each letter would be for a different house that they were trying to put under agreement weekend after weekend after weekend. Mm-hmm. I don't see that as much anymore, though. I do have, more often than not, the offer still not being accepted.
Right.
So there still is competition for a good house, to your point, from what I'm seeing on the mortgage end, just around pre-approval activity, write a letter so I can make an offer,
right.
Thing. Yeah.
Right, for sure. And I think, one mentality, buyers, I've seen a few buyers see a great opportunity, and the home didn't go under agreement after the first weekend, and no one's going after that house. And I don't understand why. I think buyers are, what do you mean it doesn't have multiple offers? What's wrong with it? Which isn't necessarily the case. And it might be a great opportunity to get into a home now.
Yeah.
And so I think one of the other things we wanted to talk about, there's been all kinds of speculation about 2019. What's going to happen in 2019?
Right.
And the National Association of Realtors is still predicting a 3.1 sale price increase, or 3.1 increase in the sale price over the next year nationally. And that makes sense. We don't have an abundance of inventory that's going to drive prices down. We're starting to get more inventory, but I still don't think it's enough.
Right.
And so with that being said, and then also the rates have been a hot topic recently. A couple weeks ago, we heard that they were going to be up a whole point by next year, and then they've dropped a little recently. Is that?
Yes. So the rates are right now, they came up and they touched and even breached 5% on average, maybe about a month ago. And since then, we've seen a fairly steady decline to where, one point last week I was pricing things out for an average 30-year fixed rate if you have good credit and a good down payment, 4.625. They're kind of around 4.75, so they're kind of running between 4.625 and 4.875 right now in that range. So we'll call that mid to high fours. Mm-hmm. is where they are, and they seem to be fairly stable there over the last week or two. This is what we're looking at.
Mm-hmm. And things are maybe less. Obviously, we're talking crystal ball here. We don't really know what the market increase is going to be next year. We don't really know what the rates are going to be next year. And so one thing we wanted to kind of break down a little bit is how these changes potentially affect what you can and can't buy. And so we figure we'll put the information out there and say, all right, what's today look like? If I'm going to buy a $500,000 house today with today's rates, what does that look like on a monthly basis?
Sure. And so the monetary policy that the government tries to put in place is to have a balance between growth and inflation. The cost to borrow relative to incomes, relative to how well business is performing overall. And the idea was, this year they were trying to raise rates to keep pace with wage growth and earnings growth. The projection had been that next year there would be a interest rate policy where at least 3 increases would be seen throughout the year. Strangely though, the market has only priced in 2. So contrary to popular belief, an increase, the Fed borrowing rate, for instance, does not directly correlate to mortgages, but it's a sign that mortgage rates will likely increase. So like today, for instance, if you're at 4.75, which is kind of where most folks with good credit are gonna be today, and you wanted to buy let's say a $500,000 house, which in this area of the world, North Shore of Massachusetts, is kind of average, right? It's pretty average for a house. And you were going to put 20% down, you borrow $400,000. At 4.75%, you're at $2,087 a month. Now let's say rates do increase. And I do think that if, sitting here December 11th, 2019, I think we will look at rates that are higher than they are today. How much higher, we don't know, but let's say it's 0.5%. Let's say we do firmly get over 5%, you're at 5.25%. So 4.75, that $400,000 loan is $2,087 a month for principal and interest. At 5.25%, that same $400,000 loan, that same purchase, everything else being equal, would be $2,209 a month. So it is $122 a month more expensive, or about, to use round numbers, $1,400 to $1,500 a year more expensive to buy if the rates go up 0.5 point, nothing else changes. Now, if you're right, I shouldn't say you, but if National Association of Realtors is correct, and we do see, what is actually considered kind of healthy appreciation, which is about 3% appreciation in the market. Let's say that $500,000 house would now sell a year from now at $515,000. You're borrowing now 80% of that's $412,000. So at $412,000 at 4.75, let's say the rates stay the same, you're still $2,149 a month. Now, if the rates also increase, which most everybody's projecting they will, let's say they're up 0.5%, that same purchase next year with 20% down, that same house that's worth $500,000 today, if it's worth $515,000 next year, and you're putting 20% down, that's going to cost you $2,275 a month. So that delta between where you are today for that house, that $500,000 house with 20% down, today you're financing that with a payment of $2,087 a month. Whereas next year, again, if the forecasts are correct or close to correct, that same purchase would cost you perhaps $2,275 a month. You're looking at a nearly $200 per month difference, about $190 a month difference to own the same house, and you're out a year's worth of equity as well, right? So you haven't started making payments on that house either. So if forecasts are to be believed, and that's really all we have to do is take the only opinion we could really take with anything but a grain of salt would be what the experts say. You're looking at a market that continues to appreciate in value, as well as interest rates that will continue to creep up to keep pace with wage and earnings growth to avoid an inflationary issue. You're looking at something that's going to cost you about $2,300 more a year to own if you wait. And you'll spend more money on it too. You'll spend an extra $15K or so on the same house a year from now, right? So there's a big difference, to your point, between a buyer's market and a balanced market. Right now, if there's 8, 9, 10 buyers for every house, let's say that number's now more like 4 or 5. but there still are multiple for a good house. There's still competition for that house. There's still appetite. The people who are looking to buy homes that weren't able to because there were 10 buyers for every house, they haven't stopped looking. Some of them perhaps are priced a little bit out of the market, but not all of them, right? So now you're still looking at 3, 4, 5 people looking at the same house who actively look to purchase. So I think that we might see a little bit of leveling off, which would be very healthy, but I don't forecast any sort of a receding of value at all, and nor does any of the experts who are polled. So
and also to your point, that $100, $200 a month, that might mess with someone's debt to income ratio. And now, I mean, it doesn't seem like a lot of money, but if you're too tight on that debt to income ratio, you may no longer qualify for a house.
That's right. That's right. Yeah, and sometimes it's not a matter of somebody pinning the needle trying to buy a house. It could be somebody who's been in a job where they receive a good portion of their income as commission. They have a base salary, then they have some commission. They've made a couple of job changes where we can't use some of that commission in our qualifying criteria, though they do have the income to make these payments. So they may be priced out just because of guidelines and application of the guidelines. Though again, I would never suggest somebody pin the needle on what they can afford. Sometimes it's just a matter of how we verify income that can be the difference between a yes and a no. So it's a great point on the debt to income ratio. It's not just whether or not it's affordable, it's can we prove it's affordable according to the guidelines. So,
yeah, I mean, I think we're all hoping for a little bit more balance in the market right now. I think everyone is tired of 15 offers and unknown final sale price.
Waiving contingencies, waiving home sales, borrowing money from parents, right?
It's been exhausting. It has been. It's been frustrating for buyers. It's been, and even the sellers have been having a little bit of difficulty because the buyers are paying so much money. They feel like they deserve so much more once they get into the negotiations and things have been falling apart. I mean, we all need a little more balance in our lives,
right?
And I think it will benefit everybody. More people will be able to sell their house because there's another house that you can go to, instead of, well, they're never going to accept a home sale contingency, so why,
the first domino can't fall.
I'd rather stay in my house that I'm uncomfortable in than be uncomfortable in a home I can't find. And so I think we're all looking forward to a little balance. And we don't have a crystal ball. I mean, that's the ultimate thing right now, is one big change can throw everything for a loop. And so the point we want to drive home today is, what you can afford today. Don't wait until next year for the hope of a buyer's market or the hope of something changing. Know what you're comfortable with. Talk to your mortgage lender. Talk to your real estate agent, and take advantage of where you're comfortable. Because we don't know what next year is going to bring.
I do know that you have to live somewhere and you should be comfortable.
It's true.
So
it's true.
That's a certainty, right? So
yeah. All right, everyone. Well, thank you for your time. Thanks for watching, and feel free to reach out to either of us if you have any questions about what your next steps are in real estate.
Thanks, Matt. Appreciate it.
Thanks, Brian.
All right.